Most people think that if you own stocks, you should always be selling covered calls on them. I disagree. And right now, I'm not selling any. Not on Snapchat, not on Robinhood, not on Mara, not on Better. Even though these stocks are throwing off some of the highest premiums I've ever seen, here's my exact reasoning and the three-factor decision framework I use to decide when I sell and when I don't. By the end of this video, you'll understand what covered calls are, why I use them to generate 3 to 10% a month on my positions, and this is the part most channels skip, exactly when a smart investor should stop selling them. Here's the game plan. First, the basics. What a covered call is and why it lowers your risk. Second, the real edge that makes this strategy work. Third, the honest trade-off. And fourth, my exact decision framework, including why I'm sitting on my hands right now. But before we get there, there's something most people completely misunderstand about downside protection, and it might surprise you. Let's start simple. A covered call is when you own a stock, at least 100 shares, and you sell someone else the right to buy those shares at a set price, by a set date. In exchange, they pay you cash up front. Right now, today. That cash is called the premium, and it's yours to keep no matter what happens. Here's a real example. Say you own 100 shares of a stock at $50 per share. You sell a covered call with a $55 strike price expiring in 30 days. For doing that, you collect $1.75 per share, or $175 cash up front. Now here's the part most people don't think about. Your break even just dropped from $50 to $48.25. The stock has to fall past $48.25 before you start losing money. Without the covered call, it only had to fall below 50. That's what I mean when I say covered calls lower my risk. My position is stronger because the stock has to fall further before I'm in the red. If the stock stays flat, I keep the $175. If it goes up a little, I keep the $175 plus some gains. The only scenario that hurts me is if the stock rips way past my strike, and I'll show you exactly when that actually matters. This is one of the simplest income strategies you can run as a stockholder. But simple doesn't mean always on. Here's the thing most covered call tutorials completely miss. The reason this strategy generates real income isn't because someone's being generous. There's a structural edge built into options pricing, and if you understand it, you understand why selling premium works long term. Options are priced based on how much the market expects a stock to move. But here's the thing. The market almost always overestimates how much stocks actually move. Think of it like running an insurance company. Your customers are terrified of a hurricane, so they pay you more than the actual risk justifies. Fear inflates the price. That's exactly what happens with options. Buyers overpay because they're afraid of missing a massive move, and over 20 years of data, the numbers prove it. The market's fear gauge, Wall Street calls it the VIX, has overestimated actual market moves by an average of 3.3 annualized volatility points every single year for the last 2 decades. That gap is what you collect when you sell covered calls. You're not finding a glitch. You're collecting the structural overpayment that the market has been making consistently for decades. That's why I can collect 3 to 10% a month on my positions. That's why if I can collect 5% a month, I will take that all day. But now I have to be honest with you, because there's a side of this strategy most people don't want to talk about. Let me show you something that surprised me when I first saw it. A lot of people sell covered calls because they think it protects them in a crash, like having a cushion if the market falls. The data says that's not really true. The CBOE tracks a covered call index called the BXM. It buys stocks and mechanically sells covered calls every single month. During the COVID crash in 2020, the stock market dropped 32%. The covered call index dropped 29%. That's 3% of protection on a 32% crash. And it gets worse. When the market recovered, the covered call index only captured about half the upside because every time stocks rallied past the strike prices, the gains got capped. Net result, buy and hold investors broke even. Covered call investors were still down about 13%. Now before you think I'm telling you this strategy doesn't work, I'm not. The point is that covered calls work best in specific conditions. In understanding when to sell them and when not to is what separates someone who uses this well from someone who uses it blindly. That's exactly what the three-factor decision framework is for. If this is clicking for you, subscribe. I post this kind of breakdown every week. And next week I'm covering cash secured puts. The other half of the wheel strategy I use to build toward my goal of $1 million. Here's where this video is different from every other covered call tutorial you'll find. This isn't a system I run on autopilot. It's a strategy I go to based on 3 specific factors. All 3 have to line up before I sell. Factor 1. Is the stock price at or near what I think it's worth? If I believe a stock is significantly undervalued, if I think it should be trading 30, 40, 50% higher, I am not capping that upside for a 5% monthly premium. Think of it like this. You own a house, someone pays you $5,000 a month to rent it. But the lease says if the neighborhood doubles in value, they get to buy your house at today's price. The rent is nice, but the trade-off doesn't make sense if you believe the house is about to be worth a lot more. Factor 2. Is the premium worth it? I'm looking for 3% minimum monthly, ideally 5% or more. If implied volatility is low and the premium is weak, there's not enough income to justify the ceiling I'm putting on my position. Factor 3. How much upside do I think this stock has from here? This is the one most people skip. If I have high conviction that a stock has a lot of room to run, even a juicy premium doesn't justify capping it. When all 3 factors align, fair price, good premium, limited near-term upside, I sell. When they don't, I wait. And here's the thing. Snapchat, Robinhood, Mara, and Better, the stocks I've been most active on, none of them pass all 3 factors right now. Before the sector got hit hard about 4 or 5 months ago, I was regularly selling covered calls on these names. The premiums were solid, the stocks felt fairly valued, it made sense, then prices dropped hard. And this is where a lot of people make the critical mistake. They see the premiums get even higher because volatile stocks have expensive options and they think it's an even better time to sell. But think about what you're actually doing. If you own a stock at $100, it drops to $75, and you sell a covered call at $80 just to generate income, you're capping your recovery at $80. If the stock then rips back to where it deserves to be, you get called out at $80. You locked in a $20 per share loss on a stock you could have held to break even if you'd just been patient. That's the cost basis trap, and it's one of the fastest ways to turn a temporary loss into a permanent one. Better is the clearest example for me right now. The premiums are some of the highest I've seen because it's volatile. The market is pricing in huge swings, which means I could collect a massive premium. But I believe Better is near its bottom. I believe it has a fantastic outlook, and I am not capping that upside for any premium, no matter how attractive it looks. It's not a system. It's a strategy I go to based on the stock, the premium, and the upside. Right now, the upside is too good to cap. So let's close this out with the exact framework. Factor 1. Is the stock trading at or near fair value? If yes, selling calls is on the table. If I think it's way undervalued with major upside, wait. Factor 2. Is the premium 3% or more monthly? If the premium is weak, the income doesn't justify the ceiling. Factor 3. Is my upside conviction limited in the near term? If I think the stock is about to make a big move upward, I hold off, even if the premium is high. Before this video, you might have thought covered calls were something you should always be doing if you own stocks. Now you know they're a judgment call. The premium is real, the income is real, the edge is real, but the when matters just as much as the how. This is what building toward $1 million actually looks like. Not running every strategy on autopilot, knowing when to collect income and when to let your winners run. One more step toward financial freedom. Now that you know how covered calls work and when not to use them, the natural next question is, what about cash secured puts? That's the other half of this income strategy. And it has a twist most people don't expect. One that makes it even more powerful in the conditions we're in right now. That breakdown is coming next.